Welcome to Ask Davis. I am Davis, and on this channel we discuss retirement and personal finance in plain language. No jargon, no fluff, just what you actually need to know. Today, we are talking about one of the most misunderstood mechanics in the entire tax code, the way Social Security benefits can quietly push you into a higher tax bracket without you ever seeing it coming. If you are between 55 and 70, or if you are already collecting benefits, this is information that could save you thousands of dollars every single year in retirement. And I am going to walk you through exactly how this trap works, why so many retirees fall into it, and the specific steps you can take right now to protect yourself. Here is the problem most people do not see until it is too late. When you were working, your income came from one main source, your paycheck. Taxes were withheld automatically, and the math was relatively simple. But in retirement, your income starts coming from multiple directions at once. You have Social Security benefits arriving every month. You have required minimum distributions from your traditional IRA or your 401k. You might have a pension. You might have investment income, dividends, interest, maybe capital gains from selling a stock or a fund. And you might even have some part-time work income on top of all of that. Each one of those income streams by itself might seem modest, but the IRS does not look at them individually. The IRS stacks them all together, and when they stack, something dangerous happens. Your Social Security benefits, which you assumed were either tax-free or lightly taxed, suddenly become up to 85% taxable. That is not a tax rate. Let me be very clear about that. It does not mean the IRS takes 85 cents of every dollar you receive from Social Security. What it means is that up to 85% of your Social Security benefit gets added to your taxable income, and that additional taxable income is what pushes you into a higher bracket. Let me show you exactly how this works with real numbers. The IRS uses something called combined income, sometimes referred to as provisional income, to determine how much of your Social Security is taxable. Combined income is calculated by taking your adjusted gross income, adding any tax-exempt interest you earn. Yes, even tax-exempt municipal bond interest counts here, and then adding 1/2 of your annual Social Security benefit. That total is your combined income. Now, here is where the thresholds come in, and this is the part that has not changed since 1984. If you are a single filer and your combined income is below $25,000, your Social Security benefits are not taxed at all. If your combined income is between $25,000 and $34,000, up to 50% of your benefits become taxable. And if your combined income exceeds $34,000, which is not a high bar by any standard in 2026, up to 85% of your benefits are taxable. For married couples filing jointly, the lower threshold is $32,000 and the upper threshold is $44,000. These thresholds have never been adjusted for inflation. They are the same numbers Congress set over 40 years ago. Back in 1984, only the wealthiest retirees paid taxes on Social Security. Today, a couple receiving a combined benefit of $3,100 per month, which is about average, plus a modest pension or IRA withdrawal, will almost certainly cross that upper threshold and see 85% of their benefits become taxable income. Let me make this concrete. Imagine you are a single retiree. You receive $22,000 per year from Social Security. You take a required minimum distribution of $18,000 from your traditional IRA, and you earn $2,000 in interest from a municipal bond fund, tax-exempt interest. Your combined income is $18,000 in adjusted gross income, plus $2,000 in tax-exempt interest, plus $11,000, which is half of your Social Security benefit. That gives you a combined income of $31,000. You are now above the $25,000 threshold, meaning a portion of your Social Security is taxable. But here is where it gets truly dangerous. Suppose you decide to take an extra $5,000 from your IRA to cover an unexpected expense, a car repair, a medical bill, anything. Your combined income just jumped to $36,000. You have now crossed the $34,000 threshold, and up to 85% of your Social Security, that is $18,700, becomes taxable income. That one $5,000 withdrawal did not just add $5,000 to your tax bill. It added $5,000 plus an additional chunk of Social Security that was previously untaxed. This is the tax torpedo. $1 of additional income can create $1.50 or even $1.85 of taxable income. Your effective marginal tax rate in that zone is not 12%. It is closer to 18 or 22%. And you never saw it coming because nothing on your Social Security statement warned you about it. I want to pause here for a moment. If you are watching this and you are starting to realize that your retirement tax situation might be more complicated than you thought, that maybe you have been leaving money on the table or paying more in taxes than you needed to, I put together something that addresses exactly this kind of planning gap. It is called the 90-Day Protocol. Retire at 62 without regret. It is a step-by-step system built specifically for people who are in their late 50s or early 60s and want to get ahead of these tax traps before they become permanent. It covers the exact kind of income coordination we are discussing today: Social Security timing, withdrawal sequencing, Roth conversions, in a way you can act on immediately. The link is in the first comment below. Now let me continue because this problem gets worse in 2026 for a specific reason that most people are not talking about. The cost of living adjustment for Social Security in 2026 is 2.5%. That means your benefit check went up. That sounds like good news, and in one sense it is. But here is the catch. Those combined income thresholds I just told you about did not go up. They are still $25,000 and $34,000 for single filers, $32,000 and $44,000 for joint filers. So every year that your benefit increases with inflation, you are being pushed closer to or further above those fixed thresholds. The IRS is collecting more tax on your Social Security without ever changing the tax rate. This is what economists call bracket creep, and it has been happening to retirees quietly for decades. Every cost of living adjustment is, in effect, a silent tax increase on your benefits. There is another layer to this that people overlook entirely. When your income goes up because more of your Social Security is being taxed, it does not just affect your federal tax bracket. It also affects your Medicare premiums. Medicare Part B and Part D premiums are subject to something called the Income-Related Monthly Adjustment Amount, or IRMAA. If your modified adjusted gross income exceeds certain thresholds, you pay a surcharge on top of your standard Medicare premiums. For 2026, a single filer with modified adjusted gross income above $106,000 will pay higher Medicare premiums. That might seem like a high number, but when you add up Social Security benefits, required minimum distributions, pension income, investment income, and the taxable portion of your Social Security that just got inflated by crossing a threshold, you can get there faster than you think. And that Medicare surcharge is not a one-time cost. You pay it every single month for the entire year. It can add up to thousands of dollars in extra premiums that come directly out of your retirement income. Now let me give you the action steps. What you can do right now to protect yourself from this trap. Step 1. Calculate your combined income today. Take your adjusted gross income. Add any tax-exempt interest. Add 1/2 of your Social Security benefit. Know exactly where you stand relative to the $25,000 and $34,000 thresholds if you are single, or the $32,000 and $44,000 thresholds if you are married filing jointly. If you do not know this number, you are planning blind. Step 2. Consider Roth conversions before you claim Social Security. If you are between 60 and 67 and you have not yet started collecting Social Security, this is your window. Converting traditional IRA money to a Roth IRA means you pay taxes now at what may be a lower rate, and then that money grows and comes out tax-free in retirement. Roth IRA withdrawals do not count toward your combined income calculation. If you convert $50,000 per year for 5 years between ages 62 and 67, you could move $250,000 or more into a Roth account that produces zero combined income for the rest of your life. That is the single most effective long-term strategy for reducing Social Security taxation. Step 3. Sequence your withdrawals strategically. Do not simply take money from whichever account is most convenient. In years when your income is lower, draw from your traditional IRA or 401k. In years when your income is higher, draw from your Roth or from taxable brokerage accounts where you can control the timing of gains. The goal is to keep your combined income below the threshold, or at least to minimize how far above it you go. Every dollar you keep below that $34,000 line if you are single is a dollar that keeps your Social Security benefit from becoming taxable. Step 4. Be extremely careful with required minimum distributions. Starting at age 73, you are required to take distributions from your traditional retirement accounts, whether you need the money or not. These distributions count as ordinary income, and they directly increase your combined income. If you have large traditional IRA balances, your RMDs can be substantial, and they will push your Social Security taxation to the 85% level almost automatically. This is why Roth conversions in your 60s are so powerful. Every dollar you convert before age 73 is a dollar that will not generate a mandatory taxable distribution later. Step 5. Watch your tax-exempt interest. I know this sounds counterintuitive. Municipal bond interest is not taxed as income on your federal return, but it is included in the combined income calculation that determines how much of your Social Security is taxable. A retiree who holds a large municipal bond portfolio might assume they are being tax efficient, and in some ways they are. But that bond interest is still dragging more of their Social Security benefit into taxable territory. You need to account for this when you are doing your income projections. Step 6. Take the senior bonus deduction if you qualify. Under the One Big Beautiful Bill Act passed in 2025, there is a new temporary deduction of up to $6,000 for individuals age 65 and older, or up to $12,000 for married couples. This can reduce the amount of income subject to Social Security benefits taxation. However, it phases out for single filers with modified adjusted gross income above $75,000 and for married couples above $150,000. If you are near those limits, you may want to manage your income specifically to stay below them and capture the full deduction. Here is the bottom line: Social Security taxation is not a flat tax, and it is not a simple system. It is a formula that interacts with every other source of income you have in retirement. The thresholds that determine how much of your benefit is taxable have not changed in over 40 years, which means more retirees cross them every single year. One extra IRA withdrawal, one unexpected capital gain, one cost of living adjustment. Any of these can silently increase your tax bill by hundreds or even thousands of dollars. The retirees who pay the least in taxes are not the ones who earn the least. They are the ones who plan their income sources deliberately, years in advance. I would like to hear from you. Leave a comment below. Have you already been surprised by taxes on your Social Security benefits? Or are you planning ahead to avoid this trap before it hits? I read every comment and I respond to as many as I can. If this was useful, please subscribe and leave a like. It helps the channel and it means more content like this one. This is Davis. I will see you in the next one.